So welcome to the Locking Your Success Options Trading for Income Weekly Update for July 21st, 2014. Before we get going, I'd like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And also, please note that we are using computer-simulated performance results, and they're believed to be as accurately represented as possible. However, they're not guaranteed as to accuracy with live execution. Okay, if you're watching this on some other venue, come on over to our website, lockingyoursuccess.com. Check out our programs and our group coaching, as well as our one-on-one coaching and trading triangle programs, and join our mailing list to get the free report, 7 Secrets to Becoming a Successful Trader, and sign up for this weekly webinar. And of course, stay tuned for everything that's in development. All right, let's get moving and kind of hop into the markets here. So I really want to take a detailed look at what's going on in the markets this week. Last week we were kind of in a situation where we had one opinion on Monday, and that opinion tended to change as new information came in the market. So if you remember, last week we were saying from a macro level, it was all systems go for the bulls. The market was very, very bullish, and we did have a pullback to a support level in the Russell, all an indication that plus we were going into expiration week, which normally is an up week for the markets. All that together kind of leaned a little bit towards the bulls taking over and having an up week. We also said, though, that there was something else going on in the charts, and that was that even though the Russell had some sort of a significant pull down, that the SPX, the Dow, the NASDAQ, they were still, they came down a little bit, but it was a very, very mini pullback, and they're still overextended. And if for whatever reason they decided to take some sort of a normal retracement, they would probably pull the Russell lower. And I was thinking, more to the next support level, which is pretty much what happened last week. Monday, we got a good bounce in the markets as expected on all the indices, and that kind of confirmed our opinion that the markets were likely to go higher. But on Tuesday, something interesting happened where you have if we look at a 60-day chart here, I'll just kind of focus in. On Monday, we got this up move. On Tuesday, we had a relatively flat move in the SPX. We had a relatively flat move in the NDX. Right, this would have been on, let's see, the 14th. The 15th was a relatively flat day on the NDX. It was also a relatively flat day on the Dow. As a matter of fact, it was a completely flat day on the Dow. So all of this together is saying, okay, well, that's fine. We had an up day on Monday. The market's resting a little bit so it can go higher, which it did do in the Dow, and it did that in the NASDAQ, and it did that in the SPX as well. It followed the following day with a higher high. However, on Tuesday, if you look at the Russell, we had a very significant down move on Tuesday when the rest of the indices were relatively bullish. Matter of fact, on Wednesday morning, early in the morning, I said, I was talking to one of my clients. I said, the market's going to be down. It's come down to the next support level as far as the Russell goes, because it was pretty clear with the other indices already being overextended and then extending higher with the Russell dropping. That combination is going to change our opinion. So this is how we use our indices together to kind of get an idea where things might go. Then, of course, we had the unfortunate event of that plane crash in Malaysia and the continuing tensions with Israel and so forth, which in general pulled the markets down a little bit on Thursday. All right, this is just a normal retracement with bad news, just to a very, very minor support level. So nothing abnormal there on the SPX. But of course, with the Russell already being weak, it pulled it down to the next support level. So essentially, that's what happened to us. So how were the results for the week? Well, the SPX, the Dow, the NDX were all up for the week. If we come to a weekly chart, right, they were all slightly up for the week, which is pretty much what was expected. However, with the weakness in the Russell and what was going on with the indice divergences back on Tuesday, The Russell was down a small amount for the week. I mean, not terrible, but a little bit. So all we did is we tested this support level and bounced. So the question is, where does the market go from here? And even though I believe the futures are taking a beating this morning, right? We're down 720. Likely going to retest our support level here, and probably I'm still leaning towards the bulls for the week. We still basically have the same thing going on, though. We have the Dow overextended, we have the SPX overextended, we have, not as overextended as it was, and the NASDAQ overextended. Not as overextended as they were, but we still have a situation where, if they come down, the Russell's going to come down to its more primary trend line, which is down here in this area. However, if the markets remain bullish, then the Russell should take off more aggressively than anything else. So I still am slightly biased to the upside, even though we're going to have a down day, at least for the open today. Slightly biased to the upside longer term. That's going to change if we get some sort of a support break in the SPX or the Dow or something. But as of right now, that's the way we go. And of course, again, this is one of those things where it could go either way. So no big opportunity here. So I have a question, and it essentially says, normally when the Russell's going down and the other indices are going up, should we conclude the Russell will be pulled upwards? Or couldn't it be the other way around, the Russell pulling down everyone? Yes. So here's the thing with the indices, right? You have to watch how they're matching each other. So what I'm looking for, is the Russell going to be pulled up, or is Russell going to pull everything else down? I'm kind of looking at what the other indices are doing to get a solid look at that. So if the Russell is going down with the others going up and the others are overextended, okay, so here I'm looking at this day, right? If I can make hopefully you can see that okay. Let's see, I think I can have a marker. I can. So here I'm looking at a marker. I'm looking at this day here where everything went up, and then I'm looking at this day here, the following day, where everything was relatively flat and the Russell was down. That being the case, this is still overextended because these are basically the SPX is at all-time highs and the Russell is failing. That, to me, that means because the SPX is at all-time highs and it tends to be a little bit overextended, that when this resets itself or goes back to normal, the Russell is going to drop. Had it been the other way around, where the SPX was down and going up, and the Russell was still continuing to go down. In other words, if the SPX was at a support level and the same thing happened, I would expect it to go the other way. So hopefully, that will work. Yes, I still have a weekly chart up. Very good. Thank you. Back on. So I still have a weekly chart up, but it's the same. It's the same thing. The weekly chart actually almost looks identical to the daily chart, which is interesting. Let me just clear this if I can. So it's the same deal here. Right, on Monday, the market's up. Tuesday, it's relatively flat. The Russell's down a lot. I'm near all-time highs here, very close. Indication the market's probably going to come down with any kind of news-related thing, and that's why I was thinking the Russell was going to go down. So hopefully that makes sense. It's a little bit harder to get. And yes, using the Russell/SPX chart in profit, I know we can get relative performance, right? Correct. All right, so hopefully that makes sense to everybody. And it can be a little bit complicated and notchy the way I'm explaining it because it's not prepared. But, essentially that's what I'm looking at. I'm looking at the SPX being a little overextended, the Russell weak. When the SPX resets, the Russell's coming down. I just thought that the SPX was going to push higher, and it probably would have if it wasn't for this news stuff going on. But we'll see what happens. And then, of course, today it looks like it almost seems like the indices, the bigger indices, want to go into a sideways range, which is going to push everything sideways because we have a lot of conflicting information. But if I had to make a call, I'd be still a little bit bullish for the week. That could go very, very wrong if we have a normal retracement in one of the other indices. All right, so that is essentially where I think the markets are going. And like I said, indecisive this week, I know, but that's what we have. We have indecisiveness in the charts. I don't think anybody really knows right now. All right, so let's look at our positions. We had expiration week last week, which was a bit of a rocky ride into expiration if you had July. But let's take a look at what we have for positions. As of Monday morning, I'm not getting any data. So let's go to 10:30. All right, so I have 10:30 data. Here is what our M3 position looked like as of Monday morning. Basically, I'm looking for a 10% profit target on this. I am, 4 days to expiration. I'm nice in the middle of the graph. I'm at the peak of my T+0 line. The market's a little wild. I'm here sitting up about $4,300 in the trade. I'm good with that. I just decided to exit this trade that morning. So between around 1 o'clock, right, 1:30 to 2, we just came and got out of this. So if we come to 1 o'clock, 1,300, this was pulling about a 43.20 profit, and we simply exited the trade. So that was, let's see, that made for a profit of, by the time it was closed, let me see if I can take a look at this, of 43.54.55, or 8.7% of our planned capital. So happy with that. It was a long trade. Had to bring it right into expiration to get anything reasonable out of it. That has been the case a lot for the last year or so. So this is the M3 is done for July. So that was a good trade there. A little more challenging was the Bearish Butterfly, which was a very rocky ride into expiration. If we come to 10:30 in the morning and shift over to the July Bearish Butterfly, with the relief in volatility, we were back to break even early in the day, and actually a little bit later in the day, I believe we were actually up a couple $1,000s, because we're getting like major theta decay in the markets and a volatility drop, right? So as time goes on, we're getting some money in this on Monday. So if I wanted to go for break even, certainly not a bad idea to exit this trade. 4 days to expiration. We're in a really high game, and the market's moving around. Not bad to exit it at all, but I decided to stay in. So by the end of Monday, with a relatively large up move, if we come to 5:30, so here we are at 5:30, up about $2,000, sitting at a delta of 66. Really no problems there. Tuesday, with the down move, was a different story. Let's just kind of hop to the end of the day. You'll see that we pulled down about minus $2,600, and with a substantial down move, I did have to make an adjustment. So what I did for an adjustment on Tuesday, which was the 15th, is throughout the day, right, I started buying 1140 butterflies. I bought 4 at 10:30. I bought 4, because remember I said I usually wait till 10:30. Ish, or at least 10 o'clock. I bought 4 at 10:30, 4 at 11, and then I started selling off our 1180s, sold off 2 of those at 11, 2 of those at 12, able to sit the rest of the day and end up in this position here, positive 197 delta, down about $2,000. Pretty much to be expected for a move like that. 3 days to expiration, right? So a bit of a drawdown there. So Wednesday, let's see. Wednesday, we got a relatively flat day, but I did end up selling 3 more of the 1180s, just to bring our delta down to a reasonable period during the day. Because remember, we had a capitulation down earlier in the day. So on the 16th, in the morning, when the market was down, we ended up selling out 3 more of these 1180s. End of the day, we ended up in 3 1180s, 10 1160s, 10 1140s. Here is what the position looked like. We're up again $2,000, another opportunity to get out of the market, right? We're 2 days to expiration. We're in a very tight position. This is a good opportunity to exit. That did not happen. I decided to take this into Thursday. So as of Thursday, we touched nothing till 10:30. The position as of 10:30 is up about $4,700. Good opportunity to exit the position. So that's when the position I scaled out of this. So how do you exit something like this? It's kind of cool. You take off these three butterflies here. Right, and you put yourself into a flat delta position. Then you're comfortable to let the market hang around a little bit or do whatever it needs to do. If the market was really moving, I could have started. It wasn't moving yet because at the time in the morning it hadn't moved a whole lot yet, I don't think, if you look at the price charts. We opened relatively flat, right? So here we are. I'm close enough to my profit target. I start scaling out of this. Then I'm going to take my directional. So now I'm in basically flat delta. So now I want to take my directional risk off the table, right? So I want to take these out. I actually sell a condor rather than trying to exit in butterflies, right? And taking on price movement risk, I sell a condor and go into something like this. So now I've drastically reduced my risk down. And then I just sell the last condor and exit the trade. So that's how you'd exit something like that. Okay, so clear trades. Anyway, by the time this was exited, market prices came up a little bit, ended up being able to get exactly 10% out of the trade. So if we run into here, I can show you the T-log here, and if we look at our reports, ended up at exactly 10%, 5,017.30 to close the trade out. So that was a 10% gain, which is our reduced profit target, 1 day to expiration. Had you stayed in this, it would have been a fight in the afternoon because we did continue to drop. Not that much though, another $7. It would have been manageable, but it would have been a pain in the butt. All right, so those are our July trades. If we look at, since all the July trades are closed, if we come in here and take a look at what's going on for the month of July, we have a bearish butterfly that took a 10% gain for a yearly total of 86.8. We have our M3 trade that took about an 8.7% gain for 49.2% for the year. We have our ROCK trade that took a 10.4% gain, was closed earlier, for 70.5 for the year, and we have our V trade, which got hammered this month. It just couldn't handle the range of price movement. Again, if you're a more skilled trader and you use some of these other concepts on top of a V trade, you could have probably pulled this back, but it was a legitimate loss for that trade. The market was just too much of a move, depending on when you entered, of course, too. If you entered at a different time, you might have made out better, but ended up with a 9.4% loss, and that's up about 10.6 for the year. So all in all, a positive month. Although we've had better months, but it's definitely a positive month. So we're happy, and we're moving on to August. So looking at August, let's take a look at the August V Condor. August V Condor. Let's just go to the end of the day on Friday. There were 2 adjustments made this week, but they were very simple, so we don't have to go over them in detail. What we ended up doing is buying back 2 of these 1090 puts. So if we look at the T-log, I bought back 1 of them on Tuesday. When the market came down, we exceeded our positive 50 delta limit. And again on Thursday, when the market came down more, we exceeded our positive 50 delta limit. As of right now, this position sits the same as it has been, except when we bought back 2 of these 1090s. And we're down a little bit of money, but if we hold support like I think we're going to and bounce, then take this V out later on in the trade, still a reasonably good trade, should do okay. So that's essentially the August V Condor. The August Bearish Butterfly. This is what we looked like on Monday. Really nice, healthy looking trade. A little bit towards the back of the position, but looking really nice. So if you remember with this trade, we actually did a roll up and an add because we had a delta theta problem before we had the roll up and add. And at the same time, when we were looking at this, doing that roll up and add, I said that was probably a bad idea, right? And the reason is because we thought that the markets were coming down that week, and they did what we said. So if we had stayed in the 1180, 1160, this position would be no problem, even through the reset. But we did go with the delta theta rules because that's what the guidelines say. Rolled up probably further than we should. As a result of that, on Tuesday, I believe it was Tuesday, the 15th, I ended up selling out on the 1200 butterfly when the market came down. So if we come to the end of the day Tuesday, if we come to the end of the day on Tuesday, we can see that I simply pulled out of the upper butterfly, and we're sitting here in one butterfly. So we go back to 1/3 entered rules, which means when we come down to 1140 or close near that area, then we're going to roll this thing back, which happened on Thursday. So if we come to Thursday, towards the end of the day, we did a rollback to 1140, which is pretty much at the money right here, and we're sitting in this position. Now, this is completely by the guidelines. If we get a reasonable bounce and we run sideways, this will be a good trade. If we get a continued down move and the market comes down hard, this will still be a good trade. If we get a reversal here and the market screams up, this is probably going to lose. So knowing that we're in a very bullish market, this probably wasn't the wisest move either. So we made an unwise move from a technical standpoint to the upside. If you're using M21 concepts, you would have known that and avoided the situation of having to roll back here. And if you did roll back and you're using M21 concepts, you would have rolled back all the way to 1110 and gone to an M3 here and preserved your profits and went for a lower profit target. But with the bearish butterfly, if you're doing it straight guidelines, then this is where we are. Not crazy about the position in general, but like I said, that's where it puts us sometimes. And if you don't pay attention to technical analysis, you kind of get into that type of a thing. So as of Friday, this position with the big up move was drawn down even a little bit more. So let's see, we are at about $2,000 profit as of Friday afternoon. So if the market does come down today into this range, and you were actually in this position yourself, we are I'd be happy to close this at about a $5,000 profit if we swing back down to the 1130 level. But I'm not going to do that because we're not 21 days to expiration yet. But if it does that on Friday, then if on Friday we're down there, this will be closed at a lower profit target. If the market shoots back up, then we'll just end up chasing it. So that's the bearish butterfly for August. The rest of them are relatively simple. We got the August M3, which had no adjustments. So we'll look at that. This trade here up about 1600 minus 25 delta is looking perfectly fine. And we have an entry for an August rock trade. Once again, with the market moving around, our charts are telling us to put the rock trade into essentially an M3 trade. So that's what we did. We entered on Thursday. This trade here, and since the market was down, I would have entered at 1120 if it was early in the day, but we entered later in the day. The market was down enough. I entered at 1110. But this ended up being, by the end of Friday, ended up being minus 54 delta. So it's sitting in this position here. This is looking perfectly fine. And we also had an entry of a September V Condor. And if we come down here, I'll show you where I entered September. I actually entered it when the market was down on Thursday, and the reason I did that is because I didn't want to be at the same strikes as I was in August. So here is what we looked like on Friday on the September V Condor. I was able to enter with the short strikes at 11:20 and at 12:40 with a straddle at 11:30. Here's what our T-log looks like on that, and here's what the position looks like. It's a little set further back than what our August position is. I don't like to be in the same strikes because I don't like to lose at the same time. But that's our September position. So we'll move on to questions, and we have quite a few already. So let's take a look at what we got here. All right, so do I trade each strategy in a separate account, or do I keep them from, how do I keep them separate from each other? All right, so if you're going to, the answer to your first question is yes, I have 7 different accounts I trade. You can trade them in the same account. You make it a little bit more limited. They can be traded together, and how you stop them is you just keep them at the same strikes. So if I have a bearish butterfly with short strikes at 11:40, 11:20, and 11:60, I can do an M3 trade with 11:60 butterflies. In other words, I wouldn't do them at the 11:50, 11:70. It gets too complicated. So I just keep them at the 11:50. And if I do a rock trade, I will keep it with those 20-point short strikes. I'll keep everything in the same strike. It avoids them from stepping over each other. I mean, the systems were very carefully designed so that they can be traded in the same account together, and they can be bounced off of each other, and they can be converted from one form to another. So that being the case, if you keep everything at the same strikes, you can do that. You can stop from stepping on each other. And not that even stepping on each other is even a problem necessarily. It puts you into a synthetically the same position, but it's a little more complicated to follow if you're a beginner. But once you get really good at this, it's not really going to matter to you if you step on the strikes anyway. Okay, over the weekend I looked at entering a rock trade for August, and the entry test told me to enter a high IV configuration. Is that what you would expect for a low vol environment? Yes. So again, this question said he looked at the August trade, and it told him to enter in a high IV configuration or an M3, right? So he entered in an M3, and that is, and we are in a low vol environment. So that's a little contradictory, right? Here's what this is why we're not looking at the IV of the market. In other words, I'm not looking at the implied, or the RVX per se, right? The RVX, which is, I'm not looking to determine whether I should be in a high IV type of a configuration or a low IV type of configuration, because this isn't telling me what the market makers think and what the major market participants are thinking as far as how far the market's going to move. It's just telling me how much fear is in the market, as in how many people are buying puts. That's what this basically tells me. It's how many people are piling into put protection. The skew that the entry test that we do with the rock trade is going to tell me where the participants think the market's going, whether they think it's going to move a lot or a little. And right now they think it's going to move a lot, or at least they're very concerned that it's going to move a lot. So I'm going to go with that and enter in a high IV configuration, even though the actual market volatility configuration is low. All right, so if I was entering in a rock today as an M3, where would I position it? I would be down, well, I don't know where the market's at now, so let me look. The Russell is down 7, we're at 1143, that's not right. We're not at 1143, are we? No, I guess we are. Okay, so we're at 1143. Yeah, so I'd still be, I mean, right now, I'd probably be looking at the 1110s. I would go, if I had to enter this minute, I'd go 1110s. If the market's up today, maybe to over 1145, I'd probably go into the 1120s. All right, so any thoughts on September Bearish Butterfly Friday? I like the M3 better than Bearish Butterfly right now because the market's been down a lot. If we get a very big up week, today resolves itself and the market's up at maybe 1200, hold 1190 that I might be liking a September bearish butterfly. Right now, I would rather be in an M3 type of a trade, especially if the market is down coming into the end of the week. It's just a safer trade to be in when there's a possibility, right? I'm not saying there's a likelihood of a big bounce, but when there's a possibility of a large bounce, if the SPX comes down this week and the Dow comes down this week and the NDX comes down this week and the Russell comes down this week, that gives us a possibility of a fairly large bounce. I'd rather be in an M3 trade. I'm just not, I mean, I'm still going to enter it as per normal guidelines, and the trade will very likely make out fine. You know, that being the case, if you're asking me if I like the entry, I don't like it particularly. So I'm not crazy about it. All right. Okay, so next question is, will I consider adjusting the August M3 in case of a large down move, or are you happy to stay as it is until one of the guidelines are met? I'm happy to stay as it is until one of the guidelines are met. I still think the market's going to be up. So, you know, I might adjust it early if at 3:30 I'm at 98 delta. Right, so my guidelines for adjusting my downside is twofold. If I get past my short strike on the M3 for August, then that's a reason to bring it down. If I get a positive 100 delta, that's a reason to bring it down. And essentially, I don't really have an interest, even if I exceed that intraday, of rolling that back, unless if I'm going to close at around, you know, up in the 90s for delta range. I consider making the adjustment early in that case, because I do have the overnight risk and stuff, and I am kind of pushing on a borderline adjustment number. All right, and then would I go over the V Condor rules? I can't go over them in detail. Obviously, we don't have time here, but essentially, I'm going to enter with 10 delta short strikes, 30-point wings, and a condor. And I do that when the 2 months out has basically expired, or if I've closed it, I might do a little bit early. So I entered September last week because July expired last week. Then I'm just going to put a straddle in slightly below the money. So if you look at this V Condor here, if you look on Thursday, you can see this is set up with short strikes here and here, which were the short strikes themselves were about approximately minus 10 delta when they came in. I have a V in here that's slightly below the money. I have adjustment parameters of positive 50 delta or minus 100 delta to the upside. And for adjustments, I'm essentially buying back these short strikes. And if I hang out too long in the center of the position, I'm going to start widening this straddle out, or maybe even eliminating it altogether to raise my expiration graph a little bit and make some money while still kind of protecting myself on either side. So those are the short and fast rules for V Condor. Like I said, it's more detailed, but to get we just don't have that kind of venue. Yeah, right. Days to expiration, right? So I will expire the trade most months unless I hit my maximum loss number or it's just abnormally risky. And days to entry is I'm going to enter September when July is done. So it's going to depend on the month. If I have a long expiration cycle, it's going to be 64 days. It might be a little bit shorter if I have a short expiration cycle, or if I have a really long expiration cycle, it might be a little longer. But it's going to be right around 65 days entry. Profit target, yeah, great questions. All right, profit target on this is essentially it's as much as I can get. Typically, it's going to run, I have a profit target. I have an official profit target of $5,000. I have a normal average gain of around $3,000. I have a maximum loss of $5,000. I usually won't get out of the trade at a $5,000 profit. I will usually flatten it out so that I can't lose a whole lot, or if it gets risky at $5,000, I'll exit the trade. But a lot of the times, if you're having a favorable month, you can pull this to 7 to 10,000. So I do stay in for those months. I do ride those out. And that is essentially, in a nutshell, the V condor. There are a lot of things that can happen with if-then scenarios where you end up rolling back one of the sides, and actually you'd only roll back the upside. But there's, different students use different rules, and I'm going to be coming. I mean, it's too detailed to kind of explain verbally. Okay, so that I believe is everything. Yes, I expire almost every. I expire V condors most of the time. I didn't expire our August because it lost. It hit our maximum loss numbers, so that one was not expired. But most months we're just going to let it go and expire it. I mean, you can always trade out a little bit early if you have most of your money in and you want to utilize the capital somewhere else. But in the demonstrations we're expiring them. Okay, I believe that's everything. Thank you, everybody, for joining me and putting up for being 5 minutes late. And we'll talk next week. Have a good luck this week trading, everyone. Bye.